You are going to get some conflicting views on what's ahead for the market, but you might decide that they're coming to the same conclusion, and it's not necessarily one you're going to like.
We're just beginning to see a trend of a weaker dollar. Therefore, I'm looking again at some foreign holdings and even gold as an alternative to the dollar. So I'm not preaching the end of the world is coming, but I'm preaching that the mega trend we saw for 15 years is over.
That's Nick Sargen, Senior Economic Advisor at Fort Washington Investment Advisors. And while he's not calling for a recession or even a global shock, which was the title of a book he wrote a while ago and that he's updating now, he is suggesting that we're about to see big changes. But we start today with Carly Garner, Senior Commodity Strategist at DeCarly Trading, who's expecting more downside risk than upside potential, but who does not think you should be going to gold to protect yourself. Plus, Rita Shula, Senior Director of Caregiving for AARP's Public Policy Institute, is here discussing their Caregiving in the U.S. study for 2025, which showed the high financial, physical, and emotional costs that caregivers of all sorts are paying in times when more people need help than ever before.
Podcast time.
Welcome to the show. This is Money Life for August the 5th. We have a phenomenal show planned for you today, but I will warn you that, we say you shouldn't be surprised if somebody comes on here and says, buy this one day, and somebody else says, sell it the next. Well, we had Thomas Windmill from the Midas Funds, Midas Discovery, and of course, he is somebody who invests in gold. We had him on yesterday. We have Nick Sargen on today, and he mentions gold, but then there's Carly Garner, and she most assuredly has a very strong opinion on gold. And I'm going to play for you a highlight of that right now.
A lot of people are putting money in gold just because it's going up, and it has been, but I've lived through 2011, and I remember all of these same stories that are circulating in gold, all the reasons to buy it, the central banks are buying this and that, you can't trust the dollar, so on and so forth. All of those things were narratives in 2011, and gold topped and took a 50% haircut and took a decade to get back. So that is not an impossible scenario. In fact, I think that might actually be what could be around the corner.
That take is pretty much a direct contradiction of what you heard Tom Windmill talking about on yesterday's show. And yeah, you'll hear Nick Sargen talk about leaning into gold, and you might come away from it all thinking,
yeah, I'm pretty confused, all right.
That's not our intention, but that will tell you what we've got with these market conditions. And I will just set you up for the discussion with Carly. She talks about her personal portfolio. She is a commodity strategist. And the commodity she is mostly in right now is treasuries. And that should tell you something. She will tell you about it in that interview. So it's a great show. I love the fact that we're getting into all this stuff and that we're not spending too much time here on the day-to-day markets, because for all the angst and anxiety over the weekend, well, the market did come back with a second consecutive trading day that it moved more than 1%. But in this case, it basically just bounced right back from everything it lost on Friday. No, I would not be too sanguine about that. But yes, that's a positive. That should at least give you comfort, even if you've got reasons to worry. And I do think you're going to get some worries potentially hearing our guests today. I'm Chuck Jaffe, financial columnist, your host here on Money Life. This show is all about independent personal finance talk. And it's not about bringing you what I think is happening. It's about getting you the best and brightest minds so that you can swim around in their brain fluid with me. And you can decide what you want to take out of each and every one of our guests, what you want to incorporate, what you want to discount, what things will give you the courage of your convictions, because that's what you're going to need to get through the disagreement that makes a market, right? You literally will hear on these two shows, one talking about leaning into gold, one talking about moving away from it. Well, you've got both ends of the trade there. You have to decide where you are in that kind of a disagreement. And you have to have the courage to stick with it, because whether your strategy is phenomenal or merely good, lacking emotional discipline to stay out your plan gives you the worst of all worlds. If you've got questions, comments, suggestions, and more, write me. I'm available at chuck@moneylifeshow.com, and I'd love to hear from you. But right now, we need to get to it. We've got a great lineup. I've told you what's coming, and we're talking technicals with Carly Garner to kick things off. So be ready for it, because it's coming right after this message.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Don't get technical with me. But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals on Money Life, where we're going to demonstrate that what is going on in the market's technicals is worth following and paying attention to. And we are living through proverbial interesting market times. Here to discuss them with me, Carly Garner. She is Senior Commodity Strategist at DeCarly Trading. She is also, by the way, the author of Trading Commodity Options with Creativity. If you want to learn about the book, tradingcommodityoptions.com will help you do that. If you want to learn about DeCarly Trading, it is DeCarly Trading, DeCarley, DeCarlyTrading.com. And you can go there to get a free trial on their newsletter by going, again, signing up at DeCarlyTrading.com. Carly Garner, welcome back to Money Life.
It's good to be here. Thank you.
I mean, I said interesting. I maybe could have used the word weird, because we got through July, not a single day with the market having moved more than 1%, from open to close, et cetera. Turned the calendar into August. Things got a little wacky, and everybody acted as if it was a huge, hairy deal. And like, here comes whatever the next thing is. Are we set up for the market to do much from here, good, bad, or otherwise?
Well, I mean, for starters, that sell-off came right in line with seasonality. Usually, the right around the turn of the month, late July, early August, we normally get a little bit of turmoil, and actually, this turmoil often extends into October. So, the jury's still out whether we get more, and I think personally we will. But it's not going to, markets don't go straight up or straight down, especially this market. It's been kind of a one-way street since the April lows, but I venture to say that we're probably in a scenario where there's a lot more downside risk than there is upside potential. And the reason I say that is when I look at a monthly chart of the S&P 500 futures, which I use the futures because they trade 23 hours a day. They chart a little better than SPY or SPX just because of that nature. There's basically a trend line that started in 2016. And if you take the highs from 2016 to 2018 through 2021, and then through the 2024 highs, trend line comes in right around 6,500. So can we go above 6,500? Sure, but the odds that we see higher than that here in the next, let's say, handful of months are pretty slim. A more likely scenario is we get continuation of the consolidation or the pullback. But the problem is I don't see any good support on a monthly chart until we get into the low 5,000. So I'm not trying to predict anything, but the probability is that we probably see much lower before we have a chance at much higher.
Again, when you say you're not trying to predict anything, I mean, basically you're looking at bands, and what you're really saying is, if we wind up seeing the downside risk materialize, there's not really anything that stops it. So if it gets on a roll, it could go to the low 5,000s. That's a little different than saying, I expect it to go immediately test support.
That is correct. Yeah, that's correct. So I'm not a portfolio manager. I'm a futures and options broker. So what we're doing, like with our clients, is we're encouraging them to hedge, because hedging is the type of thing you want to do when you can, not when you have to. And I think we're in a situation where it's an amazing time to hedge, even after Friday's sell-off. And obviously, the VIX popped up a little bit, but even after that, it's still relatively cheap to hedge, and you can do it strategically by using what's called a risk reversal, sell calls, use the money that you collect to buy puts. It's kind of complicated for a show like this, but the reality is, if you're trying to hedge after the market's already selling off, it's too late. You do it when you can, not when you have to. And I think that's what we're doing. For my personal portfolio, again, I'm not recommending anybody do anything to this sort. In fact, most people shouldn't, but I've got mostly treasuries in my portfolio. I'm not just telling you that to give you an idea where my mind is. Again, there's more risk than reward in my eyes to being long stocks, and I'd rather be long. Treasuries are, regardless of where you look at the curve, paying 4 to 5%. And if you hold the expiration, you get that money almost no matter what. Not, there are very low probability odds that something really wild happens and the US government melts down. That could happen, but it's not likely. So I'm just playing the odds here, and the odds are treasuries are a much better buy than stocks.
I want to follow up, and not that I want you to dig in and give us too many details on your personal portfolio, but the question would be, when was the last time you were mostly treasuries? And when you make a move to that, how long do you normally stay there? Because you are somebody who's looking at various things, and the market could get through, a situation where even if it took us all the way to support in the low 5,000s, you might be at that point going, okay, now there's much more upside potential than downside risk. So you could flip it around. So how quickly do you turn on something like that?
This is a fair question, and it's a good question. So the last time I was this overweight treasuries and underweight stocks was I started the process like let's say late 2024 and then just kind of slowly allocated as time went on. Luckily, I'm not saying I had a crystal ball or I'm a genius or anything like that, but luckily by late 2024, early 2025, I was almost all treasuries and I was in a very comfortable position to be buying. When a lot of people were playing defense in April, I was playing offense and allocating back into stocks in my portfolio. As is always the case, I didn't buy enough. I tried real hard, but it was such a quick move and V bottoms are hard to get reallocated in. I mean, I felt like I was being aggressive, but in hindsight, I wasn't being aggressive enough. So here we are, and I'm hoping for maybe some sort of replay. And if it doesn't happen, worst case scenario is I leave a little money on the table, but I can sleep well at night. So I'm happy with that. I'll also give you a little more background to explain why I'm that aggressive in my allocation towards risk off. And it's because as I mentioned, I'm a commodity broker. So my business, I've learned, it took me a while to learn this, a couple of cycles, but my business goes south when the economy and the markets go south. So when everything's booming, market's doing well, my income's doing well. But when everything starts to fall apart, my income, I'm a commission based, it's commission based income. My income drops significantly. So unlike most people that generally are the ability to have income coming in to buy market dips or recessions, they can keep putting money in. I'm actually in a situation where my income doesn't halt, but it gets cut dramatically. So I'm not in a place to if let's say if a recession hits, my income is going to be cut so much I'm not going to have all that free cash flow to put into stocks at good prices. So I'm just a little bit different than the average person. So this is why I'm as aggressive in being allocated towards treasuries than most people should be. But yeah, so that's that.
When it comes to the commodities markets, have you started to see that decline in activity that you might see as we're getting into a bear market, or is that something that doesn't come until we're getting into real trouble? Because I've had plenty of people talk about how they love commodities, and certain commodities, most notably gold, have been doing really well in these market conditions. So what's your take on the commodities markets as you're watching them now?
So a couple things that I'll say there. Our industry is an industry that thrives on good economic conditions. So when things are tight and people's pocketbooks, the first thing they stop doing is speculating, right? So we're not really talking about buying gold or precious metals as a part of their portfolio, but commodity speculation really dies when people start pinching pennies. So we start to see this before. It's kind of like, and I also live in Vegas, coincidentally, which is, a tourist town, a gambling town. When people don't have as much free cash flow to work with or discretionary income, first thing they do is cut their trips to Vegas. They stop gambling, they stop playing, that sort of thing. It's kind of the same thing in the commodity markets. So we start seeing people pull back in their trading, take money out of their account and put it somewhere that's a little more guaranteed. I'll just leave it at that. And we are starting to see a little bit of that. Not dramatic, but a little bit. So there's a small red flag waving. But as far as commodity markets goes, I mean, things are moving. The two really big hot markets are, as you mentioned, gold and silver, which I personally believe, I know this is contrary to most experts, but I actually think it's a sell the rallies market in both gold and silver. And the reason I think that is I think the US dollar has bottomed and I think it will continue to work its way higher. Dollar index, I think, goes to like 108 to 110, which is basically where we started the year roughly. Not quite, but roughly. And if that happens, that changes the landscape on a lot of commodities, particularly the metals. Live cattle is another really hot market. We've got a lot of, we work with farm hedgers and speculators, and cattle is at all-time highs. And not only that, but it's probably the most volatile it's ever been. So there's a lot of action going on there. So commodities are, as a sector, are actually pretty hot. But I am seeing signs of cracking as far as people pulling back and people getting, going into more safe assets.
In terms of the safe assets, how much will the picture for you change when we wind up seeing rate cuts? As you pointed out, you can clip a nice coupon in treasuries right now. You think that there is a little bit more downside risk. I know that the president thinks that if we see rate cuts, it'll be a boon for the market, but the market's already priced a lot of stuff in. So I'm not sure we're going to get that reaction. So in your case, when we wind up where, okay, we see rates get cut, et cetera, how much will that push you towards a time where maybe you want to be getting more aggressive?
Well, I think you're right. I'll make a couple comments there. The stock market is priced for perfection, in my opinion. And so even if we get rate cuts, I think the market might question why those rate cuts are coming. And so I don't think the rate cuts are going to be as supportive as some people believe they will be. And you have to keep in mind, although the bond market's not pricing in a plethora of rate cuts, we've been through a few cycles that in which rate cuts were expected just here in the last couple of years. They never came, but they were expected, and the stock market rallied all throughout that time on the on the idea of lower rates. So for whatever reason, the stock market hasn't given any of that back, but that's another story. Another thing I'll point out is with rates this high, the math does not math. When you look at, there's basically two primary risk off assets, treasuries and gold. And if somebody has money that's sitting on the sidelines and they want to put into a risk off asset, they have those two. There's a few others places to put it, but primarily gold and treasuries. Gold does not pay a dividend. So if you're buying gold here above 3,000, the only way that you come out ahead is if you hold for your holding period. If it's 30 years, you're probably going to have a good shot at coming out ahead. If your holding period is less than 10, the odds are you're probably not going to do very well on that investment. At least, I mean, you might, but the odds are not that great. And the reason being, treasuries pay interest and they're at all time, I'm not going to say all time lows, but they're 20-year lows. Gold does not pay interest and it's at an all time high. At some point, those things have to come back in. The spread between those two assets is too wide based on the math. A lot of people are putting money in gold just because it's going up, and it has been, but I've lived through 2011 and I remember all of these same stories that are circulating in gold, all the reasons to buy it, the central banks are buying this and that, you can't trust the dollar, so on and so forth. All of those things were narratives in 2011, and gold topped and took a 50% haircut and took a decade to get back. So that is not an impossible scenario. In fact, I think that might actually be what could be around the corner.
Well, that would be alarming if that's what's around the corner, but that explains why you're being
Right.
somewhat cautious. I wish we had a little bit more time to explore it. Unfortunately, we don't. I really appreciate the perspective. It's been, my audience will know and pick up. This is continued on a number of conversations we've had with others and really brings in some interesting things to light. Thanks so much for joining me. Let's do this again in the not too distant future.
Thank you.
That's Carly Garner. She is senior commodity strategist at DeCarley Trading. DeCarley, spelling it because you can go online to decarleytrading.com. You can also sign up for free trials of their newsletter there. And her book, Trading Commodity Options with Creativity, you can go to tradingcommodityoptions.com for more information there. We are just getting started on the August 5th edition of Money Life. We've got much more to go, including Nick Sargen, Senior Economic Advisor at Fort Washington Investment Advisors. So stick around. We're living the money life. We're right back at it in just a moment.
Asset managers, you know how hard it is to stand out in this crowded space. VettaFi is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, VettaFi can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at VettaFi.com.
Now Money Life looks at what the survey said. Yes, welcome to The Survey Said on Money Life. This is where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at how, well, it's not just their money, it's everything around their life is affected by caregiving. Because there is a new report. It is the Caregiving in the US 2025 report out from AARP that looks at how America's 63 million family caregivers are reaching a point where the process of caregiving is affecting their financial wealth, their actual health, it's making them their mental health, and much, much more. This is a groundbreaking study that's been going on for over 20 years. So they've done it roughly every 5 years since 2004. And I'll point out that if you want to get more information, this is one that you want to look up, particularly if you see your family making choices about caregiving. Here to discuss it, Rita Shula. She is Senior Director of Caregiving for AARP Public Policy Institute. They are one of the arms that overlooked the study. Again, it's aarp.org, but find the direct link that we have in our show notes or where you find Rita on our guest page so that you can dig into the results for yourself. Rita Shula, thanks for joining me on Money Life.
Thank you for having me, Chuck.
Let's start with a bit of a definition here. Like when we're talking about providing ongoing care, what's the spectrum? I mean, I think we all have a pretty good sense of what the maximum level is. But when we talk about caregiving and family caregiving, does it start with like just living together or providing a little bit of financial assistance? And does caregiving typically follow a path that, starts with minimum and moves along typically with somebody's financial or physical health?
That's a loaded question. I think oftentimes when we think about caregiving, we think about one specific instance. So you do hear about someone that is taking a parent to a healthcare appointment, or someone that is helping a loved one manage financial situations and things. But what we're really seeing and what we're talking about in this survey are family caregivers that are doing all of the above. So, in addition to doing things like transporting someone to appointments or helping to manage financial bills and other things, they're also really providing complex care. And this can be for a younger child or it can be for an older adult. And so we see family caregivers doing things such as helping someone bathe, preparing special diets. We also see family caregivers doing things as complex as helping give insulin, managing or changing catheters, helping with incontinence. So the list really can go on and on. And what we see is these individuals, and the survey showed that the individuals, the caregivers that are providing this care, are doing it at a higher intensity. So they're doing it more and they're doing it for a longer period of time.
Well, help us understand that a little bit as well, because, like I said, you guys have done this study 5 times over about 20 years. So, how much worse has the situation gotten, or how much bigger is the burden that families are reporting? And what are the reasons why the burden has gotten bigger? Like, again, because it can be a complex situation where you've got parents and kids. Is this simply about we've got, the baby boomer generation getting to where they need more assistance and it's a big generation? Or is there something else driving this?
There are a number of different factors. When we talk about individuals providing higher intensity care, we're really looking at individuals and the reason for providing that care. Yes, part of it is around the population is getting older. The other piece, and this is a very big factor that really affects and impacts so many, is that caregivers, family members, friends are actually being asked to do more. And so in the past, you wouldn't necessarily see someone living as long with the conditions that individuals are living with, and you wouldn't see those individuals being cared for in the home. They would either be cared for longer periods of time in the hospital, or many would end up having to be placed into a facility. But what we're seeing with family caregivers now is that they're coming home with these expectations that they're having to do all of these really technical tasks. I We had a conversation with a family caregiver, and she cares for her son. She cared for him from birth, but now he's an adult in his 30s, and she describes his room as an ICU. So she's saying, I'm providing ICU level care for 24 hours a day. And so we see a broad range of care that families are providing. But one of the important things is that they're providing that higher intensity care. They're also working. So they're not just home, but they're also working or trying to balance work. And many of them are sandwiched.
I don't want to sound callous or crass, but how much did the people recognize what they were getting into? Like, I know plenty of people who very much want to care for their parents and help their parents and do everything they can. But then when they get in there, they find that the process of caregiving or the burdens of caregiving are much bigger than they anticipated. So, on the one hand, this is a labor of love. And on the other hand, that doesn't make it less of a labor. And in fact, it may be a lot more labor, as you go in lovingly, you're not thinking about how big this gets. So, when we talk about the strain that folks are experiencing, how much of that is because they weren't fully prepared for what they wound up finding or getting into?
That's a really great question. And you're right. We hear that all the time that, individuals want to provide that care. In fact, 51% of family caregivers surveyed in this report find that caregiving gives them purpose. But to the point that you just made, you can have purpose, but that doesn't mean you don't need supports. And I think quite often individuals are just saying, this is something I'll do. I need to take care of my parent. I need to take care of my child. Of course, this is something they will do. But then they get into this situation, and oftentimes it's not a slow start. Oftentimes it's a crisis situation. So, yes, someone may fall and break a hip. Someone may have a planned knee surgery. And those are things that are more acute that with healing and time, a shorter period of time, they'll be able to recover from. And so that caregiving time is shorter. But quite often, we're seeing individuals that are providing care for someone with dementia, that are providing care with someone with ongoing health conditions such as heart failure and other serious conditions. And that is really more complex, and the care they need to provide are more complex. And we hear from family caregivers all the time, and we heard from this in this survey that they do not feel prepared to take on the task that they are being asked to take on. We know that 22% of family caregivers are saying that they've been trained, but that leaves almost 70 plus percent that are saying we've never received this training at all. And they're being asked to do really complex things.
Once someone is in the caregiving cycle, what kind of relief is available? And is that relief largely only available to families that can afford it? In other words, if you're dealing with somebody who's going down the dementia scale or what have you, you may not want to make the choices that you need a facility or what have you, but whether you need one or not, you're going to have to be able to afford it. So what are the things that people can turn to for help as they need it?
We need in this country, there are existing resources to help family caregivers, but there is not enough. And it's really important that we understand that there is a cost for much of the care and support that family caregivers need. And the individuals that get caught are those that are in the middle. The individuals that can't necessarily write a check, so to speak, to be able to pay for care out of pocket. And then they're also caught in the middle of either they or the ones that they care for are not able to be on any public supports. And so these are the individuals that are really struggling. We know that almost 30% of family caregivers in this survey talk about the difficulty in finding affordable services. And so while there are public programs that are available, for instance, an individual who qualifies for Medicaid in many states is able to access something called home and community based services, which provides supports in the home so that a family caregiver can have someone come into that person's home and provide care and can access other resources. We also know that many family caregivers turn to their employers, and not that those employers are necessarily giving them resources to afford care, but the employers are able to offer paid time off for caregiving. But there's not nearly enough of that support for family members.
Yeah, that was one of the things when you're looking at it, what your employer can do, even just from kind of trying to have family friendly policies, things that allow you to have more flexible time, things along those lines. A vast majority of caregivers are unpaid, but given what we know about the issues they may face over time, things that we're learning about in the study, should they be like, obviously in some cases it's not a choice, but should families, as they decide how we're going to go through this, and maybe it's different when you're talking about caring for children and what have you, but when you're talking about what you're going to do with, mom and dad, and you've got multiple siblings, et cetera, should the families be saying, at the very least, maybe let's use mom and dad's assets, if there are any, to provide some support for whichever family members providing the care? Like, is there anything in the model that says when you pay that caregiver, that family caregiver, you dramatically change the stress situation?
Well, it's interesting. This particular survey doesn't really address that. What we do address in this survey is learning about those individuals who are able to get paid. So there are programs through Medicaid, through some state-based programs, as well as the Veterans Administration, that all offer some form of compensation for family members that qualify. What I like to say and what I have been saying is that, family members are not getting wealthy from receiving this paid compensation. It is not a replacement for having a full-time job. And what we know about these 9 million family caregivers that are receiving this payment is that they tend to actually be lower income. So these are adults that are either on Medicaid themselves, they're more likely to be caring for someone on Medicaid, and they are of lower income. And so many of them have had to quit work in order to provide care because when it came to, okay, I can work, but then I have to pay out of pocket for this care, the numbers just didn't add up. But I think one of the things that you're raising is extremely important is that we don't talk enough and we don't talk early enough about what it means to provide care for someone. And so by the time caregiving actually occurs and the situation actually happens, nobody's really talked about what is this going to look like? How much is this going to cost? Who's going to pay for this? How are we going to make this work? And so what we find oftentimes is people in a very reactionary mode. Because they're just having to deal with the crises that's in front of them, which is why it's so critical that as you can, the earlier planning around what does this look like, not just if somebody is older, but anybody can get an illness. Anytime, any situation can happen that puts us in a capacity where we'll need care. What does that look like for your family?
Last question in limited time. You mentioned Medicaid there. There have been talks about cuts to Medicaid. I don't want to talk about what the cuts mean. I want to understand what percentage of caregivers who, as we have noted, are already stretched financially, are helped out by Medicaid, because the loss of Medicaid or a reduction in Medicaid would presumably make it that the next time you guys are doing this survey and you guys do this study, the numbers we see now would be a lot worse the next time if you just increase the burden on people. So, of the people we're talking about who are already stressed, what percentage of them might or others might find it worse with cuts to Medicare?
Well, we know that there are nearly 8 million family caregivers from this survey who are on Medicaid. And we know that whether they are receiving Medicaid themselves or whether they are caring for someone on Medicaid, that any cuts to the resources that they currently receive will truly impact their access to affordable and quality services, which means individuals will potentially have to place someone in a nursing home, but that would be at a higher cost. Individuals may have to leave work because they're not able to get resources into the home. So we know whatever cuts that there are to Medicaid will absolutely impact family caregivers.
Rita, fascinating stuff, really important stuff. The show's called Money Life because life money sounds stupid, but life comes first. And this is one of those cases that people really need to be planning for it and thinking about it. Thanks for helping us get a good idea of what the picture is at this point.
Absolutely. Thank you.
That's Rita Shula. She is Senior Director of Caregiving for the AARP Public Policy Institute. If you want to learn more about caregiving in the U.S., not just caregiving generally, but the study for 2025, well, aarp.org. And we have the direct link in our show notes on our guest page. Well, we know that you care about living the money life. And if that's the case, you're going to let us take a quick little break, and then we'll be back to the financial talk in just a minute. Stick around. Welcome back to Money Life, where it's time for the big interview on the August 5th edition of the show. Returning to Money Life now, Nick Sargen. He is Senior Economic Advisor and Consultant at Fort Washington Investment Advisors. If you want to learn more, well, westernsouthern.com/Fort Washington. But among the other things, and one of the reasons that I love chatting with Nick is that back in 2016, he wrote a book called Global Shocks, an Investment Guide for Turbulent Markets. We discussed the book on the show back then, but it was really set up for turbulent markets. Now, we've seen the markets be turbulent since 2016, but we might be seeing more now. So it's a great time for me to be saying, Nick Sargen, welcome back to Money Life.
Thank you very much, Chuck. Glad to be with you.
Speaking of turbulent times, we did not have them in July. July was downright boring, and boring was fun. We didn't have any days in July when the market moved 1% from one day to the next. Didn't happen on the S&P 500. And then we flipped the calendar to August, and yeah, we had some trouble. And I know, because I read some of your commentaries, you are expecting things to get more volatile. So give us your base outlook on where we are now, having gotten bad jobs numbers last week, having gotten recently the Fed at least holding off for a little while longer. What's your base case right now?
My base case is that, first of all, we at least have some clarity now on how significant the tariffs are that Trump is imposing on all U.S. trading partners. They are the biggest increase in tariffs since the 1930s. So I would say, for the most part, the U.S. tariff rate has gone from 2% at the beginning of the year to 17%. That's an enormous increase, unprecedented. And yet, to your point, the markets took it in stride. And I think that there were two arguments. One, the market got shaken in April when we thought we were in a major trade war with China, and then that got diffused. So you don't have to worry about U.S.-China trade war. But then the second thing that the market was saying was, well, all these economists are telling me it's going to be bad, and I don't really see it showing up in the data for the economy or for prices. So here's where I think we are today. My argument is that the reason you haven't seen it so much in prices is pretty straightforward. Firms, knowing that there were going to be these huge tariff increases in April, they just stockpiled their inventories, and for the most part have been running them down. So we're now at the stage where we're going to see some price effects. But then the question was, well, what about the economy? And everybody was saying, the economy is resilient. We all know that. And the jobs market is holding up remarkably well, they cite the unemployment rates being relatively low. So basically, what happened Friday, of course, was you got a number for July that was weaker than forecast, but that wasn't the story. The story was the backward revisions to the two prior months of more than 250,000 fewer jobs than we previously thought. So all of a sudden, you're now saying, wait a minute, is this economy really as stable as I thought it was previously? That's the question I think everybody is, wondering now. And Chuck, my point has been the following, there's two fallouts from the trade war. One is the price increases that go with the tariffs. But the second is the uncertainty. And so one of my points is it would have been one thing if Trump just said, okay, here's what we're doing and made clear from the get go where tariffs were going to settle everything. It hasn't. As we all know, it's been rolled out and it's been quite erratic. So you're a businessman. You got to make a decision. How do you make a decision when you have no idea where prices are going to settle? And even then, when you think that now you've got a deal with somebody, that deal could change because the trade negotiations, make no mistake, these are not signed off by legislatures, either in the US or foreign countries. These are the equivalent of Trump deal. Let's make a handshake deal. That's all they are. And so my argument is that it's really, if you said to me, am I more worried about the inflation impact of higher tariffs or the weakening impact of the higher uncertainty? I'd say it's the latter. I'm more concerned about we just are living with this cloud over us, and it's hard for anybody to make business decisions.
When you talk about that, obviously we've been hoping we'd get some clarity, and we have more
Yep.
clarity now. But even in all of this, I mean, when you talk about that these are kind of handshake deals and all the rest, we've seen some numbers in the deals that don't entirely make sense. You've got the European Union agreeing to import more oil, like by a factor of 2 or 3, things along those lines,
Yes.
than we've seen. And it doesn't suggest that you can actually make those deals work. Are you worried that the clarity we're getting is basically false clarity? In other words, okay, we now know how this feels, but since we don't know for sure that it's going to get out, that the deal will be kept, and that, there won't be something that happens down the line that things won't somehow revert? Like, is that part of your problem here? Because we were supposed to be getting through this and feeling better about it.
And I think you're spot on that. In the case of, let's take the European deal, which, by the way, most people would say who won, meaning who got their way. They'd say Trump clearly did. He had threatened that he'd boost tariffs to 30%, but then he settled for 15. But still, he got concessions out of Europe that a lot of people in Europe are very unhappy about. But then, to your point, then part of it is, well, on let's make a deal. Okay, he wants to also say, not only did I get a higher tariff, and by the way, they've got to lower their tariffs or keep them low. But he's also trying to say, well, I got them to make commitments of investing, whether it's in this case that the natural gas or whatever. And yet, again, right away, I start reading experts on this going, A, there's no way they can do it, and B, it's impossible to enforce because this is the government saying what the private sector is going to do. So you're absolutely right on that. The other point I'd make too, Chuck, at the same time, we got to deal with Japan. And that one, guess what? The Japanese were happy with the deal. It sounded similar to you because they got a tariff rate of 15%, whereas Trump was threatening 25. But why were the Japanese happy? And the reason is that now the duties on their cars that get shipped into the US are 15%, not 25%. Chuck, who is complaining? It's the US auto producers who are saying, wait a minute, they're getting a better deal than we are because they are facing on car parts, and this is that are not part of the US, Canada, Mexico arrangement. They're paying 25%. So now you've got US car manufacturers lobbying that this is hurting our business. And the big three have announced if the current rates are maintained, they're going to lose in total profits close to $7 billion collectively in 2025. So this is an illustration that I give you of, hey, we got a deal. Trump and company will put on the best face forward, but the story is far more complicated. And that's why don't overreact to the headline. The devil's in the details and whether you can actually achieve what the stated handshake was.
Let's talk about the headlines that had people wanting to react over the weekend. I very seldom get even the least bit interest in what the market's doing short term, but
Right.
because we had such a benign July, the fact that things changed and what have you made it look like, okay, we're heading into August, can be rough. That gets us into September and October, certainly can be rough. We've actually had a year that, for all of the talk and the volatility and whatever, the year, if you closed your eyes and just went from January till now, has been pretty smooth and on the upswing for most of it. Do you think we're due? Whether it's a long period of sideways or a correction or a downturn, how worried are you that we're going to have to get through some stuff no matter what's going on with clarity and the rest on the big picture?
My message is, folks, this economy, which appears resilient in many respects, it's facing headwinds. I would say that there were two premises that underlay the big rally that we got in the stock market once we had the truths with China. One of it was the infamous taco theory. Trump always chickens out. And so people would say, well, whenever Trump would make a threat, don't take him seriously. I'm going to take the other side of the trade. Chuck, what we now know after the August 1 deadline, he did not chicken out. And in fact, as I say, he got virtually everybody that he's dealing with, that they're the ones that were making concessions. So premise number one was, don't pay attention to the tariffs because it's just negotiating. No, folks, these tariffs are in effect, and they're not necessarily as high as April 2, but they're still the highest. They're a 15% increase. So here's the way I tell the story, Chuck. If I told you, okay, what's a tariff? It's nothing more than a sales tax on imported goods. So if I went and said the U.S. is now going to raise the sales tax on goods in the U.S., that's going to be everything. Everybody would go, oh my God, that's huge. But this case, you've had then the second part of the story, apart from whether Trump is just negotiating or is he serious, is you had the argument that, well, I don't see any of the economic effect that all these economists were telling me. And so my story is that's fair up until this last week. This last week, not only did you see that the jobs picture was far weaker than we previously believed, but then let's take another thing. You got the second quarter GDP report. And again, the administration will say, hey, we have 3% growth. After, remember, we had slightly negative growth the previous quarter. But folks, that has to do with all the volatility I was talking about. Everybody rushed in and imported before the first quarter was over, and then they drew down inventories. If you strip out the data and say how much actual final domestic demand was there. It was 1.2%. So this U.S. economy that had been growing, let's say before the start of the year, I'd say ballpark 2.5%, is now growing in the first half of this year at half that pace. So you've got that. And then let's talk again. Hey, the tariffs were supposed to be about increasing manufacturing jobs. We've had 3 consecutive months of decline in manufacturing jobs. So I'm basically saying the two key premises of the market rally that A, Trump isn't serious about tariffs, and 2, that the impact is, I'm saying he most definitely is serious. That I will not budge on at all. About, well, we haven't seen the impact. I'd say, folks, fasten your seatbelt. You're just beginning to see the impact now. So that's why I think there's more ahead of us. And again, I'm not in the camp that recession, I'm not saying that word. I'm not talking you're going to go into a bear market. I don't understand how the market, though, can keep setting record highs every day when now we're confronting major uncertainty.
I'm going to cut a question out of here because my next question was going to be, you are the author of a book called Global Shocks. Were we setting up for one? But if you're not seeing recession, et cetera, you're not seeing a global shock, as you just said. You're just seeing a market that's got to back away from the records because they're unsustainable. So let's use our time a little bit differently with what we've got left. How much for anyone is this a time to be rejiggering their portfolio? Not about panicking, not about making moves, but we've had this big move in international stocks. Like, if you came up with a plan a couple of years ago, the market has moved you off that plan. Is this rebalance and go back to basics, or is this lean in certain areas? And if so, what are those areas?
Since the 2008 financial crisis, I said, Chuck, if my portfolio is going down, it's going down on US soil because I felt we were the most dynamic economy, and partly technology, partly because we're a more mobile society than many others. So I was over arguing for really 15 years, overweight US stocks relative to international stocks. And I was also fairly bullish on the dollar. What I'm saying now, and it's not the near term, it's in global shocks. What was the most significant shock? It was the breakdown of the fixed exchange rate system. That was my first job. I was at the US Treasury in the early 1970s. Chuck, it had repercussions for 2 decades. I'm now saying why I'm concerned is we've gone from a system where the US believed in free trade to a system now where we're saying, no, we don't believe in that anymore. This could rival the breakdown of Bretton Woods. So what I'm basically saying is it's time for me to go back in my own portfolio. I'm going to be more diversified now than before, meaning that I'm not doing the overweight that I used to of the US relative to the rest of the world. I'm being more diversified. At the same time, I'm not in the camp that the dollar is not going to be the world's reserve currency, but I'm in the camp that we're just beginning to see a trend of a weaker dollar. Therefore, I'm looking again at some foreign holdings and even gold as an alternative to the dollar. So I'm not preaching the end of the world is coming, but I'm preaching that the mega trend we saw for 15 years is over.
Nick, I got more questions, but unfortunately, this interview, like the mega trend, is over. We've come to the end of our time, but it's always great to catch up with you. Thanks so much for taking the time. Let's do this again as we get around the turn of the year. We'll see how things are playing out at that point.
Thanks, Chuck. It was very enjoyable.
That is Nick Sargen. He is Senior Economic Advisor at Fort Washington Investment Management. It is Western Southern, because they're part of Western Southern, westernsouthern.com/Fort Washington. If you are looking for more information, we've got his commentaries linked up as well, where you find him on our guest page at moneylifeshow.com. We will come back in just a moment. We'll put a bow on what's been a great show. We'll let you know what's coming tomorrow, and we will cross the finish line. Don't stop now. Finish line's in sight right after this message.
Verify is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at verify.com.
We are back to put a bow on this show. We let things run just a hair long. I hope you found it worth it. You don't get as much from me. That's okay. I don't mind. Hopefully you don't either, but let me know you're thinking about this. We do try to stay as close as we can to our footprint. But I hope you enjoyed this show. Man, we have a phenomenal lineup coming for you. Tomorrow on this show, Daryl Cronk from Wells Fargo. Thursday on this show, Urian Timmer, Director of Global Macro for Fidelity. That by itself will make the next two shows great, but more really interesting stuff coming out, because also on tomorrow's show, Jenny Harrington, who wrote a book about dividend investing. So we'll be talking dividend investing in the market call, and another interesting survey that we'll be taking on. Thursday on the show, of course, Todd Rosenbluth and more. We've got big things coming. Lock us in. Plan to be here. And if you think I'm overselling it, if you don't like how it turns out, let me know. But also, if you hear us getting someone on the show and you have a question for him, don't be shy about saying, hey, Chuck, could you maybe ask this question? I can't always do it, but like I got a great question recently from Tristan in Bellevue, Washington, that I'm going to try to make a question for Todd Rosenbluth the next time the ETF of the week goes for something that is options oriented. And that's the kind of thing that, you know, yeah, you can send me questions and we'll try to get them answered, maybe in the context of just doing the regular show, but also we can get them at times with the experts or the people that we're talking to. So don't be shy about suggesting, hey, if you're talking to this guy, what do they say about that? Meanwhile, if you're looking for something to celebrate, it is National Work Like a Dog Day.
Did that dog just say hi there?
No, the dog was working like a dog, so he didn't say anything. It's when they're not working like a dog that they come up and say hi there. It is National Underwear Day, which may be a little TMI. Like, isn't that, so you need a special day? Don't you kind of, most people maybe, aren't they involved every day? I don't know. It's National Night Out Day, which is weird because it should be National Night Out Night, right? How do you have National Night Out Day? You have to have Night Out Night. And then on the food front, National Oyster Day and Green Peppers Day. My guests today were Carly Garner, Senior Commodity Strategist at DeCarly Trading. It is DeCarlyTrading.com. Her book, Trading Commodity Options with Creativity, go to TradingCommodityOptions.com. Rita Shula is Senior Director of Caregiving for the AARP Public Policy Institute, AARP.org. Their Caregiving in the U.S. 2025 study, we have the direct link for that in our show notes. And Nick Sargen is Consultant and Senior Economic Advisor at Fort Washington Investment Advisors, westernsouthern.com/Fort Washington. They are part of Western Southern. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from James Gunn, who said, "Money doesn't buy happiness, but it does buy happier." And yeah, you can make yourself a little more happy with more money. You can also make yourself happier with the right attitude. And you should always have the right attitude about your money. And that attitude should be that until we do this again the next time, that the best thing you can do for your money is to not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil. You must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.